Hey traders, Gavin McMaster here from Options Trading IQ, and today we're looking at the Jade Lizard Strategy. Just before we do, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So in today's video, we're going to look at the Jade Lizard Strategy, where an investor is looking to collect premium and limit the risk to one direction, which is generally on the downside. The trade is like an iron condor, but contains one unprotected side, which means the trade involves naked options and is therefore not suitable for beginners. In terms of the trade setup, investors who are participating in the Jade Lizard Option Strategy are attempting to find a stock with volatility skew. The skew should be a smirk, which means the implied volatility of the out-of-the-money puts are higher than the at-the-money strike implied volatility. An investor will sell an out-of-the-money put and simultaneously sell a bear call spread that is also out of the money. The goal of the Jade Lizard is to collect premium where the total premium is greater than the difference between the two calls. This way, the trade has effectively zero risk on the upside. Let's assume an investor sells an out-of-the-money put with a strike price of 20 that expires in 1 month on XYZ stock for 80 cents when XYZ is trading at 22. The investor will also simultaneously sell a 24 to 25 bear call spread for 30 cents. This makes the total premium collected for the trade $1.10, so the 80 cents for selling the put and the 30 cents for selling the call spread. The only risk that the investor assumes on this trade is downside risk. If XYZ stock moves above $25 per share, the investor would lose $1 on the call spread, but gains $1.10 from the premium collected for a net gain of 10 cents. The investor profits from the trade unless the price of XYZ moves below the strike price of the naked put by more than the premium that is collected. So you can see it's also kind of a bullish trade as well as playing the volatility skew. Let's look at an example on SPY. So this is from 2020. SPY is trading around 311, and we looked at selling the July expiration 280 put for 276. So we received $276 in premium for selling that put, and then we sell the bear call spread, which is 335 to 338, so 3-point wide spread, and we received just under 30 cents for that spread. So overall, we've received over $3 in premium. The width between the two calls is $3, therefore we have zero risk on the upside. And you can see that here on the payoff graph. The thick green line, that's our expiration payoff graph. Very low risk of only $3 in total risk on the upside. So call spreads are 3 points wide, and we've generated $300 in premium, which means there's zero risk on the upside, plus whatever we pay in commissions, a little bit of risk there. The biggest risk, as you can see in the payoff diagram, is a big drop early in the trade. So for that reason, we're not only looking to play the volatility skew, we're definitely looking for a stock that we're bullish on. We may even be willing to turn it into a cash secured put or a wheel trade. If it drops below the short strike, we might be willing to take ownership of the stock, turn it into a covered call. So you can definitely see more risk on the downside. And you can see here with the three different timelines, how the trade progresses over time. So if it drops early in the trade, we're losing. But if it drops after 9 days or so, our break-even price is a little bit lower. And if it drops after 18 days, our break-even price is all the way down here near 290. So we can handle a drop in the trade or in the stock. We just don't want it to happen too early or too sharply. If the trade is constructed correctly, there'll be only one side of the trade that has the chance of suffering a loss, which is the naked put. The loss on the put side is unlimited until the stock reaches zero. The maximum gain is limited to the combined premium received for selling the put and selling the call spread. And that will occur if the stock ends between the short put strike and the short call strike. If the trade's constructed correctly, there'll be no break-even price on the call side, because the worst that can happen is the trade ends with a small profit. This is reliant on the option premium received being more than the distance between the two call strikes. On the put side, the break-even price will be equal to the short put strike less the premium received. Vega is the Greek that measures a position's exposure to changes in implied volatility. If a position has negative Vega overall, it will benefit from falling volatility. And similar to an iron condor, this trade is short volatility or negative vega. That means that an increase in implied volatility after entering the trade will be bad for the position, and a decrease in implied volatility will be good for the position, with all else being equal. Theta measures the rate of decline in the value of an option due to the passage of time, and it's also known as time decay. This type of trade is positive theta in that it makes money as time passes, with all else being equal. This is because the trade involves selling a naked put and selling a call spread. Generally speaking, option strategies that involve selling options are positive theta. In terms of the other Greeks, we've talked about delta. The Jade Lizard is a positive delta trade because the positive delta from the sold put is much higher than the negative delta from the short call spread. So overall, positive delta. This trade has negative gamma, and gamma indicates how much the delta of an option will change as the price of the underlying asset changes. As a positive delta trade, we have the risk that the price of the underlying will fall sharply, causing an unrealized loss or a realized loss if we close the trade. Volatility risk is also a consideration for this trade. If volatility rises after the trade initiation, the position may suffer losses. So, in summary, the Jade Lizard is an advanced strategy that involves selling a naked put and selling an out-of-the-money call spread. The trade is taking risk on the put side in order to create a trade that has zero risk on the call side. The trade aims to take advantage of volatility skew by selling an expensive out-of-the-money put and leaving it unprotected. Hope you enjoyed the video. If you've got any questions, please sing out. Otherwise, have a great day.